Hi students, today we are going to discuss the preparation of partners capital account. In the last class we have studied what is capital account and the methods of preparing capital account. Capital account, we know that it is a personal account prepared in the name of each partners to record their capital related journal entries. It's a personal account, and capital, we know that it's a liability to us, so it will have a credit balance in most of the case. So there we have discussed the two methods of preparing capital account: fluctuating capital method and fixed capital method. In fluctuating capital method, all the journal entries related to capital will be entered in the capital account itself. So the capital account balance will change from time to time. That is why it is called fluctuating capital method. Another one, fixed capital method. In that method, only the journal entry related to capital will be recorded in that capital account, and all the adjustments related to capital will be shown in the separate account called current account. So since only the capital is mentioned in capital account, fixed capital balance will always be fixed unless there is introduction of additional capital or withdrawal of money from capital. So this video here we are going to discuss how to solve a question related to the preparation of capital accounts of partners. Here we are explaining a question. By pausing the video, you can write down this question in a paper, because we are going to solve this question in a separate slides. So at that time you have to refer that answer. For that a question is needed. So you pause the video and write down the question. Okay. Now the question reads like this. A, B and C are partners sharing profits and losses in the ratio of 2:3:1. Their capitals are rupees 1 lakh, rupees 1,50,000 and rupees 2 lakh respectively. They entitled interest on capital at 6% per annum. This per annum in short form we will write PA. In coming questions and all we will write PA denoted as per annum. During the year, A introduced additional capital rupees 70,000. The balance of capital which was given was the opening balance. Then additional capital introduced by A 70,000. Then A entitled a salary of rupees 5,000 per month, and B has to get commission of rupees 20,000. During the year, partners withdrew rupees 5,000, rupees 3,000 and rupees 2,000 respectively, and their interest on drawings is calculated as rupees 250 for A, then B 150 and for C 100. At the end of the year, the firm earned a profit of rupees 1,50,000 after making other adjustments. Now, you have to prepare a partner's capital account under fluctuating capital method and fixed capital method. Now we are going to see its preparation. How to prepare partner's capital account. See, this is a partner's capital account. This partner's capital account, it is prepared under fluctuating capital method. So we have studied that partner's capital account is a personal account prepared in the name of each partner. But here we have not prepared separately three different partners capital account. We prepared all the three in a combined form by keeping amount column for all the three partners in both the sides. That is enough. So the heading can be given partners capital account or capital account of partners. That means capital account of here A, B and C under fluctuating capital method. So we know that it is a personal account. Personal account will have an opening balance and that opening balance in the case of capital will be in the credit side. So what is the opening balance here? It is given in the question that A and B and C are having the capital. For A, how much was given? 1 lakh. So opening balance should be shown on the credit side. What will be the end for that? What will be the journal entry? By balance wrote down. For A, how much? 1 lakh. A 1 lakh. For B, how much? 1 lakh 50,000. And C, how much? For C, it is 2 lakh. Then next, it is given that A has introduced additional capital. So it increases the capital. Thereby we will write that in the credit side. So whatever amount increases the capital will be shown on the credit side, and whichever amount decreases the capital will be shown on the debit side. So drawings and all will decrease the amount of capital. So that can be debited. And salary, commission, profit, all these things will be credited. If there is loss, where it will be shown? It will decreases the capital, so it will be shown on the debit side. So first, next we will write additional capital. So what is the journal entry if brings additional capital? What is the journal entry of entering capital? Bank account debtor to partner's capital, or bank account debtor to capital. Here bank account debtor to whose capital? A's capital. So in A's column we will write by bank. By bank will be written. In bracket, if you want, you can write additional capital for understanding purpose, but for exam purpose it need not be written. So if you want to mention it as additional capital for future reference, you can do so. So who introduces that? A introduced. How much? 70,000 is introduced. So 70,000 for A. And here given that interest on capital, 6% interest on capital will be given. That will be given on the opening balance. So interest on capital will be credited. So we will write interest on capital there in the credit side. Interest on capital is written. For A, how much? 1 lakh into 6%. How much? 1 lakh into 6%, 6,000. For A, 6,000. Then for B, 9,000. And for C, how much? 12,000. Then another important thing is that it is there in the next sentence. A is entitled to get salary at the rate of 5,000 per month. So salary will be credited to whose capital? A's capital. So A's salary given how much? 5,000 per month. So for a year, how much? 60,000 will be shown. Then next sentence what says? B is to get a commission. How much? 20,000. So for B, commission we have to show. Commission will be credited. So credit side, commission by commission. In whose column? B's column. How much? 20,000 will be shown. Then next sentence says that they withdrew 5,000. A withdrawn and B withdrew 3,000 and C withdrew 2,000. That decreases the capital, so it will be debited. So debit side we can write to drawings. To drawings, how much? For A, 5,000. For A, 5,000. So for B, 3,000. 3,000. And for C, 2,000. So that's all. Simple things. Then interest on drawings. That also decreases the capital, can be debited. Interest on capital to interest on capital. For A, how much? 250. B, how much? 150. And C, how much? 100. So that is written. Now next sentence it given that profit, share of profit. Say profit share, we will take that profit share from an account called profit and loss appropriation account. That we will study later. What is profit and loss appropriation account and how it will be prepared, everything will be discussed later. So now, for understanding purposes, we can say that profit and loss appropriation account is an account prepared to appropriate the net profit. That means net profit recorded in the profit and loss account will be transferred to an account called profit and loss appropriation account. And from that, what are the appropriations and further adjustments? That means amount transferred to reserve, amount paid to partners, such adjustments will be written in appropriation account. So profit will be remaining amount will be taken from there. So we will write here profit and loss appropriation account. So profit and loss appropriation account, for understanding purpose, you can write in brackets share of profit. If it is share of loss, it will be on the debit side. For A, how much profit, how much was their total? 1,50,000. So for A, 50,000, 2 by 6. 2 by 6 of 1,50,000. 2 by 6 of 1,50,000 is equal to 50,000. For B, it is 75,000. And for C, it is how much? 1,50,000 into 1 by 6, 25,000. So these are the things. So we will write which side is more. We know how to balance the account. Which side is more, that amount will be written on the total column. So total columns we can write. For credit side is more, so credit side we have got the answer. Total we have got, and for all the three partners we have got, and that will be written in the debit amount column also. Debit total also the same thing. Okay. Now where you will get the balance? Balance will be there in the debit side. Debit side we will write balance carry down, return. For A, how much? 2,80,750. And for B, 1,50,850. And for C, 3,84,900. See, capital account balance changed or not? Yes, it is changed. Opening balance was 1 lakh for A, now it became 2,80,750. So like that for all partners it changed. Why it changed? Because all the adjustments related to partners' capital are recorded in the capital account itself. Okay. Once again, all the journal entries which increases the partners' capital will be shown on the credit side of the partners' capital account, and all the journal entries which decreases the capital will be shown on the debit side of the partners' capital account if it is prepared under fluctuating capital method. So the balance of capital will change. Sometimes it may be a debit balance also instead of credit balance. If amount on the debit is more, it will be having debit balance. Suppose instead of profit we are getting loss, that we have to write in the debit side as to profit and loss appropriation account. So sometimes we may get, if there is huge loss, we may get a debit balance. So that is the speciality of preparation of capital account under fluctuating capital method. Now next we have to discuss preparation of fixed capital method, that we will discuss in the continuing video, next video.